Okay, why don't we start? Good evening, everyone. I welcome you to this webinar. In particular, I welcome Dr. Ralph D. Haas of the EBRD to the Mishra Center for Financial Markets and Economy at IIM Ahmedabad. Just to give a brief background, the Mishra Center undertakes research on financial markets and the economy in the Indian context, but with the global markets as the benchmark. We facilitate research by IMA faculty and doctoral students working in finance, economics, business strategy, and related areas. The center organizes seminars, workshops, and conferences. We also engage with relevant regulatory authorities, as well as with industry bodies and other stakeholders. With this brief introduction to the center, I hand it over to Professor Joshi Jacob to take it over for the webinar today. Over to you, Joshi.
Good evening, everyone who has joined for today's talk by Dr. Ralph. Let me give a brief introduction of Dr. Ralph to you. He is the Director of Research at the European Bank for Reconstruction and Development, and he wears multiple hats. Before I go into that, he's a PhD from Utrecht University. He has worked as a senior economist at in the Prudential Supervision Department and Economic Policy and Research Department of the Dutch Central Bank. He is also a part-time professor of finance at KU Leuven. He is a CEPR Research Fellow at the European Banking Center, Senior Fellow at LSE Institute of Global Affairs. He is a recipient of the William Duisenberg Fellowship Prize. His research interests, largely is across international banking, financial inclusion, small business finance, and development economics. He is a prolific publisher. He has published in leading journals in finance, including Journal of Financial Economics, Review of Financial Studies, Review of Finance, American Economic Journal, Journal of European Economic Association, and Journal of International Economics, and many others. Today we have a exciting topic and very contemporary, that's actually about a directed lending program towards female entrepreneurs. Very unique data sets being employed in the research. Let me not now stand in between his interesting talk and you. With that, I welcome Dr. Ralph once again to the Mishra Center. Just a small note, if any of you have questions anytime, please feel free to write it on the chat box along with your name. I will read it out to the speaker. Thank you.
Okay, thank you very much for that very kind introduction and for setting the scene for the paper. And indeed, if you have questions, you can use the chat, but also I think don't feel afraid to ask questions while we go along. I'm happy to take questions while we go along, so we can make this a bit interactive. So this is a paper joined with two co-authors, Halil Aydin, who is at the Central Bank of Turkey, which is important to mention because a lot of the data we're going to use are actually from the central bank. And so Aydin has really been, Halil has really been instrumental in getting those data and working with us on the analysis. And Çağatay Birsan, my other co-author, is at the EBRD, but also at UCL in London. And the paper is called Directed Lending to Female Entrepreneurs, Micro Evidence from Turkey. So basically what this paper tries to do is to evaluate whether it's possible for international organizations like EBRD to stimulate lending to particularly underserved groups in society, and if so, along what margins that may actually happen. But the motivation, I think, is a bit broader and a bit more general. So we know that in many countries, but in particular many emerging markets, smaller firms are often those that lack a credit history because they often tend to be younger. They have fewer connections compared to large firms, and they also have little collateral. And so for all of these reasons, financial frictions between firms on the one hand and banks on the other hand tend to be relatively high, and banks respond to that often by rationing credit. And so what you see is that if you look at a distribution of credit across the whole firm population, a lot of credit is really bunched around the largest firms in the economy. So large firms have easy access to bank credit, often also to bond markets. And then small and medium-sized enterprises and medium-sized enterprises find it much more difficult to access bank credit, let alone having access to bond markets. Now, this is problematic if those firms actually would like to have credit to make more investments, because if they cannot access the credit, they therefore have to forego investment, and they stay small, right? So this really perpetuates these heavily skewed firm size and firm productivity distributions that we see in a number of emerging markets, and that sort of is one of the driving forces or one of the expressions of low aggregate total factor productivity in some of these economies. So this is just to say the fact that smaller firms actually lack access to credit can have important macro implications. Now, all of what I've just said holds true for female-owned enterprises as well, and actually it holds true even more so for female-owned enterprises. So we know that in many countries there are actually very many female-owned enterprises. In particular in emerging markets, there's no lack of women who are entrepreneurial and who set up businesses. But a lot of these businesses actually, again, have limited credit history, limited connections, limited collateral. And so they feel the brunt of credit rationing even more than their peer enterprises that are owned and run by male entrepreneurs. And I think what's becoming increasingly apparent is that even when female entrepreneurs are actually not, that much riskier or not riskier at all as compared to their peers in let's say, in the same industry, they may actually, face additional hurdles in the form of either discriminatory laws, so laws that discriminate against female entrepreneurs relative to male entrepreneurs, either directly or indirectly, or they may face discriminatory lenders. And so there's some evidence from about discriminatory laws coming from India, in fact. On discriminatory lenders, I have a paper with my colleague Michelle Brock, where we basically look at lending by Turkish banks and show that the lending requirements that loan officers come up with tend to be very different when we present files to them as coming from a man or as coming from a female, right? So we do an experiment where we can actually show that these loan officers tend to discriminate depending on the gender of the applicant. So then, if these frictions are even more important for women, then as a result, we would expect, and indeed we see, if we look at the data, that female entrepreneurs remain, very heavily overrepresented in the left tail of the firm side distribution. So there's, in general, a large tail of small enterprises in many emerging markets. If you see where female entrepreneurs are located, that is, disproportionately in that very long, thin left-hand tail. The good news potentially is that, if one would remove some of those barriers to female entrepreneurship, so if we would make lenders less discriminatory, if we would make laws more gender neutral, if we would make credit more easily accessible for female entrepreneurs, then that could actually have big impacts, not just at the firm level. So these firms would probably become more productive, but we would also expect in the aggregate to have higher productivity growth in the economy, and also as a result of that, quicker economic catch-up or convergence between poorer and richer countries. And so there's an increasing, a nice sort of macro finance literature currently emerging, with some models calibrated on Indian data, in fact, showing how big these effects actually can see. So helping women to access credits, to become more entrepreneurial, and to reducing those inefficient misallocations of entrepreneurial capital, reducing that distortion can actually really add up at the macro level. So that's sort of what we have in the background of our thinking when we start to evaluate the program that I'm going to talk about in a second. Now, I think if policymakers, broadly speaking, across the world, agree on one thing, it's probably that in many countries, and in particular in emerging markets, small and medium-sized enterprises, and in particular female-owned enterprises, are actually often, unable access credit, or can only access credit at very high interest rates. And so, there are different schools of thought about how this can potentially be addressed. And I think, I would maybe, but it's a bit of a caricature, but I think they're sort of they're broadly speaking, three consensus or three approaches. So the first one I would call the Washington consensus, which is basically all about making credit markets work better. And so in the end, that will also sort of trickle through in the sense that not only large, but also small firms will benefit from these reforms. And so we have seen a lot of these reforms in the last 20, 30 years. So many countries have strengthened creditor rights. Many countries have introduced collateral laws. Countries have introduced credit registries, like the one we're using in today's paper, or they have introduced credit bureaus. And countries have also liberalized in many cases. So they have allowed foreign banks, for instance, to enter, and that really gave, in many cases, in particular many emerging markets, really competition a shot in the arm and increased competition in these banking sectors. And so there is a lot of literature showing how that has affected, and in many cases has positively affected, competition in credit markets and therefore access to credit. Now, the problem is that while on average, these reforms have had positive impacts in terms of, increasing the overall amount of lending and reducing the interest rates that are being charged on average, they may not necessarily benefit specific underserved segments, such as younger firms, smaller firms, female-run firms, firms in remote area, etc. And so those are often the segments in the business community that policymakers, for whatever reason, there are a variety of reasons why they may be concerned about this, but we do see that policymakers are often particularly concerned about these underserved segments. And so, to just give you two examples, the thing about foreign bank entry, we know that foreign banks in many cases have made host country markets more efficient and more competitive. But again, that has not necessarily benefited all borrowers. In fact, we know that foreign banks tend to cream skim, so they tend to focus on the best clients in the market. And that may in fact mean that in a new equilibrium after foreign bank entry, some borrowers, and particularly relatively opaque borrowers, may actually lose out and lose access to bank funding. Okay, so this is a good example of a positive average effect, but a negative effect on certain underserved segments. Likewise, you can think about policies that increase competition in banking markets, which tend to be, on average, good for potential borrowers. It becomes easier to get access credit, and interest rates are going down. But that doesn't necessarily hold for small and medium-sized enterprises. We know that a bit of market power may actually be necessary for those banks that engage with SMEs in order to make lending to smaller firms and opaque firms actually profitable in the long term. So again, competition may not be particularly helpful if your goal is to really allow small and medium-sized enterprises to get better access, or in the case what we are looking at today, to make sure that female-owned small-scale businesses actually get easy access to credit. So a number of countries have then, gone the other way, either more recently or historically, and they have, and so I think India would be a good example, of course, of that as well, by having a banking sector that is very, very heavily dominated by state banks. And so there are very good theoretical arguments why state banks may actually improve welfare if private banks are not providing enough credit to projects that are socially desirable. And so that's, of course, a very good justification for having state banks. In practice, we also know from a large number of studies, and I'm just mentioning three here. So the Schleifer and Vishny study is a cross-country study. The Carvalho paper is about Brazil, and the paper by my co-author and colleague Çağatay and his co-author Orkun, they have a recent paper on Turkey. But there are many other papers in this literature, basically showing that even state banks are set up with the best of intentions. They do often succumb to political pressures and politically motivated lending, which often, not always, but often tends to be inefficient in an allocative sense. Okay, so in theory, having state banks may work. In practice, there are many constraints and many potential problems with having state-run financial institutions. And so there seems to be this sort of third way in which people are thinking these days about how to best reach out to underserved market segments. And that is sort of a combination of the first two, and that is directed lending. So that is basically the topic of today's talk. So directed lending is basically taking public money, but basically pushing it into the economy using private, commercially run banks. Okay, so you can, for instance, think about a public development bank or some other government institution that has funding available, rather than taking the public development bank itself or taking a state bank and directly lending to end borrowers. What happens with directed lending is basically that funding is channeled through private banks, which are then asked to on-lend to a specific market target segment. Okay, so that can be small and medium-sized enterprises, female-owned small and medium-sized enterprises, can be microcredit, it could be firms operating in remote areas. Again, for whatever reason policymakers would like to stimulate, these restrictions can be basically added to these directed credit lines. And so what these typically combine are a senior credit line from a public development bank or straight from the state to commercial banks with a use of proceeds clause. So basically these banks get access to additional funding, but they have to on-lend that to particular clients, let's say to small and medium-sized enterprises. Often these credit lines are then combined with a first loss risk cover, so a guarantee system, a credit guarantee system, so that banks really can sort of experiment with these new borrowers that they normally would lend to, or would not lend to, or would lend little to. And then the loan officers of these institutions typically also get trained, and there's technical assistance. So this is also really about teaching banks how they can successfully and profitably reach out to these new clientele target segments. And these programs are becoming increasingly popular, exactly because it's this sort of potentially very nice combination of using the financial firepower of the state, but using the allocation mechanisms of the private sector to actually lend it, hopefully in a sustainable and commercially profitable way to end borrowers. So I'm just giving here some examples of recent loans by a number of multinational institutions. So the IFC is the private sector arm of the World Bank, the International Finance Corporation. So they have been spending a lot of money on these programs specifically for loans to female-owned enterprises. The African Development Bank is doing this, the European Investment Bank, the Inter-American Development Bank. There's also a consortium of development banks, the Women Entrepreneurs Finance Initiative, that also has a pot of money on its own. And so, as you can see, there's literally billions of US dollars that are being spent on these directed lending initiatives to push public money through private banks onwards to, in this case, female-owned enterprises. Now, the question is whether this actually, whether this works. And there's very little evidence, or there's basically no concrete or no rigorous evidence on whether this works. Of course, these loans are being disbursed, and they are in most cases, or virtually all cases, also being paid back by these banks. But the question is, in the short term, whether that money that is being provided to these female entrepreneurs wouldn't have been provided anyhow by these banks in the absence of these programs. So it may very well be the case that if banking systems are very liquid, the additional liquidity that you inject as a policymaker is just going to substitute for other funding, and so the net effect may actually be zero, or be very small. And in the longer term, the question is, of course, whether you actually can durably teach banks to start to lend to a new target segment that they previously weren't lending to. And again, it may very well be the case that you provide these senior loans, you provide these credit guarantees, but by the time that banks have paid back these loans to the state or to the development institution, that's also when they stop lending to these targeted borrowers, such as female-owned enterprises. So it's not obvious at all, I would say, that these programs are actually successful, even if they are being disbursed and they are being paid back in time by the end borrowers and by the banks that are involved. And this is something that has actually been repeatedly been pointed out by the evaluation office of the World Bank, who an organization, as I said, through the IFC is actually providing a lot of that funding themselves. So what we try to do in this paper is actually to get our hands on really good micro data.
Can I
that,
have a clarification?
Absolutely.
Yeah. So in the directed lending program, is there any incentive for the participating banks, or is there? How are they actually sort of encouraging them to lend?
Yeah, so that's a very good point. So there are some incentives in the sense that they get a access to additional loans from these development institutions, which often come at a slightly cheaper rate than how they can borrow at the market. Now, in the case of Turkey, which is a very competitive banking sector, that financial incentive as such is relatively small. So these subsidies are relatively small, in particular in the program that we are looking at. But I think the most important aspect is that often there is a temporary credit guarantee, which is very interesting for these banks because it allows them to experiment, right? So a lot of these banks may actually they may be uncomfortable or unfamiliar with lending to female enterprises, or they have only been doing this in Istanbul and Ankara, for instance, but not further to the east. And with these guarantees, these temporary guarantees, they can basically try this out and see whether it works. If it works, they can probably continue doing it. If it doesn't work, then at least part of the loss is being paid by the development bank, in this case the EBRD and the European Union.
So the effective capital adequacy that you require for these loans is lower, given the guarantee first loss.
So to what extent so that's a good point. So I don't have the answer to that. I mean, if your question is whether the Turkish supervisor, so I'm making a note at the same time, whether the Turkish supervisor would treat these loans as less risky because there is the guarantee associated to it. I'm not sure. I would guess so, in particular because in Turkey there is a separate government sponsored guarantee program as well. But I would expect that effect is quite small because the guarantee is only up there to 10% of the total loan portfolio. So banks still put 90% of their own money on the line, right? But I have to check. That's a very good point. Yeah, I don't know whether there's actually, in terms of capital adequacy regulation, whether the regulator makes a distinction between loans under this program versus a regular SME loan.
Oh, thank you.
Sure. Okay, so what we're going to do is to really see how a large program like this, and so this is going to be about a large directed lending program targeting female entrepreneurs in Turkey, how we're going to try to use microdata to really trace down how that program trickles through the Turkish economy, how it affects the lending by these banks on average, but also in a differentiated way across different districts of Turkey. And to what extent women are being, the right type of women, if you will, are being targeted by this program. So three main questions we have in mind at the moment. A, can directed lending durably increase bank lending to female entrepreneurs? And so durably is a very important word here. We really want to know whether after the initial maturity of the loan has come to an end and the loan has been repaid, whether the bank has basically made a durable change in its lending practices. Then we want to understand which types of women-owned businesses actually gain access to credit, right, if any. Is there an increase in lending to these businesses, and so what are the characteristics of these businesses? For instance, are they more or less risky than the typical business that the bank lends to? Now, that of course you can only answer if you have good data on loan taking by firms and also loan repayment, which is where the credit registry comes in that we're using. And then we also want to know what are the real economic impacts, again, if any, on these female-owned enterprises that basically get access to credit as a result of this program. Okay, so that's another question that we would like to answer. So let me give you a preview of the findings in case I don't make it all the way to the end. So yes, we do find that there is a durable increase in credit to female entrepreneurs in an absolute sense, but also relative to lending to men by the same banks at the same time, right? So we see that there's actually an increase in the share of total lending that goes to female entrepreneurs. You also see that overall, but I will show you some event study graphs that will clarify this. Overall, this is quite durable, but we are currently collecting more data to see whether in the really long term, the effect is sticky enough as well. And so again, because we have these data from the credit registry, we can actually see how banks are expanding lending to women because we can really look at the micro data, not just at the aggregate data. So we see that they basically lend more to women in three ways. One, they lend more to pre-existing female borrowers. So they load up clients that they already have before the program starts, which is good to know, but not super exciting, I think, from a development perspective. They also poach clients from competitors, right? So that is interesting. So they look at competitors in the same district, and then they try to get their best clients to join their bank. Again, this is not necessarily bad news, but this is another way of saying this is that you inject more competition into the system, and banks start to fight, quote unquote, for the best clients. And so we know from other literature that this may be this may go hand in hand with lower interest rates.
Is that an attempt to easily access, acquire clients because you had been reluctant to lend, and you know that some banks had been lending to them, therefore they probably are better, borrowers? Is that possibly the reason why they are being?
Absolutely, I think as part of the incentive that we give to these banks. Excuse me, and as a result of the guarantee that we give, banks may be more comfortable than they were before in trying to poach clients from other banks. Now, whether that is because they believe that these other banks that maybe already have a higher percentage of lending to women do a good job or not, that may be part of the story. But I think a bigger part potentially of the story is that before the program, they may not have felt comfortable enough with trying to poach clients from other banks because adverse selection was really high. So basically, if you try to get clients from your neighboring bank, your neighboring competitor, you may in fact end up with the worst clients of that bank, right? So the good clients stick around, maybe because the existing bank will give them a better deal just to keep them attached to the bank. And then the competitor bank may let go of the bad banks or the bad firms, and so you basically get into an adverse selection equilibrium.
One follow-up on this: is it that where they are poaching it from, they were non-participant banks, or all of them were participant banks?
So we do not look at that. So that's a very good point.
Because if it is a non-participant bank, you can probably compete on the interest pricing the loan, right?
Yes, absolutely. Yes. So we haven't looked at that, but there's nothing that prevents us from looking at that because we have the credit registry data, so we can do that. That's a very interesting point. So far, we just know that they're poaching from other banks. But
another question that we have from the audience. This is from Anshuman Paul. Can I read it out? Yeah. So, is there any merit in clearly segmenting the banks at the outset based on their target segment? The same lender need not lend to both mega corporations as well as to SMEs. Is it possible to promote specialization within lenders with different government regulations based upon your borrowers, who your borrowers are, and their creditworthiness? So broadly, I think the intent of the question is that should you expect an increase in lending from everyone because there is some specialization and so on? Therefore, isn't it?
So that's an excellent point, and so we currently. So I think there was initial selection in the way the five, and I will talk a bit more about it in a second, but in the way that the 5 banks were selected out of the larger number of banks in Turkey. So we're going to compare these 5 banks with about 19 control banks who are very similar in terms of their ex-ante focus on small and medium-sized enterprises. Now, I think a broader policy question is whether sort of there is specialization by banks into these types of clients, and I think that is the case. But it's I would argue, also based on some other research that I'm currently doing using data from Portugal, that actually the focus on, for instance, certain sectors, or the focus on certain types of borrowers, such as young clients or startups, differs a lot across branches within one and the same bank. So rather than seeing that certain banks specialize into, let's say, female entrepreneurs, or specialize in young entrepreneurs, financing younger entrepreneurs or startups, or financing certain industries, we actually see that there's a lot of variation within banks. There's more variation within banks than across banks in that sense. And so that is some of the variation that I will talk about later on when we compare how banks, where we're basically trying to see how banks are responding to this program in different districts, depending on their lending portfolio in those districts. Okay. So basically what we find is we see that these treated banks expand credit to pre-existing female borrowers. So that's the maybe the slightly boring part, or the expected part, but they also poach from clients, and they crowd in, importantly, I think they also crowd in clients that have never before borrowed, right? So at least not according to the credit registry. So we can really see this is really about sort of drawing people into the financial system, or increasing financial inclusion, whatever you want to call it. And so these percentages here are sort of slightly sort of roughly the proportions in which this happens. So about 60% of the total impact is due, 60% of the total lending due to the program is due to lending more to pre-existing clients. But then there's also 40%, which is really about banks trying to find new clients, either by poaching them from competitors or by crowding in these first-time borrowers. While they try to crowd in these first-time borrowers, we also see that they take slightly more ex-ante risk. So these people are, these women in particular, tend to be slightly younger and therefore more risky. But we also see that doesn't really materialize in realized risk. So these clients are actually good clients. And then we also see that there's, again, this is the part of the paper that we're still working on, but we see that there's some variation across Turkey. In particular, that banks are actually using this program to expand their lending to female entrepreneurs, in particular in those areas where their initial market share is relatively low. So it really allows them to sort of become more competitive in those areas, in those districts where they were relatively uncompetitive beforehand. And then when we look at the real effects, we see that the data seem to indicate that actually it helps these women to expand their operations. And also increases the chances of business survival. So it seems that having access to that credit is actually helpful. Now let me talk a bit about the program itself. So this was about 300 million euros worth of credit lines to 5 commercial banks in Turkey. There was this use of proceeds clause that I mentioned. So banks had to on-lend this money to female entrepreneurs, and they actually had to supplement it with some of their own funding. So in total, there was about 420 million that was being pushed into the market to provide female-owned small and medium-sized enterprises with loans. As I mentioned before, there was some risk mitigation, which may be one of the features, as we discussed, that made this attractive to the banks. So there was a partial credit guarantee up to 10% of the total pool of finance loans. And this could be another sweetener for these banks. There was a lot of technical assistance. So banks and their loan officers were really trained about how to lend more to female-owned enterprises, what type of products women need relative to men, but also more simple but very important things like sort of optimizing the management information system of the bank so they can actually collect and monitor gender disaggregated data, which is something that none of the banks was actually able to do at the start of the program. And so this is exactly where we would expect that some of the longer term impacts of a program like this may actually be coming from, right? So you can see even when that credit line, even if those 300 million has been repaid, banks may still have changed in the way they lend because they have received this technical assistance. And so they now have been taught how to lend differently than the situation before, combined potentially with the fact that there is this risk mitigation. So they've also been allowed, they have been given sort of a safe space where they can experiment with these borrowers, and they can find out firsthand that they can actually do what they have been taught to do. So these are the numbers of the total number of treatment banks that are present in each of these districts. This is the market share. So you basically see that the banks are basically pretty much present throughout Turkey, with some overweighing in the western part and the southern part, which is exactly the regions where economic activity is also concentrated. But this is not just a story about Istanbul and Ankara. It's clearly, you can clearly see from these pictures that basically throughout Turkey, these banks, these 5 banks, were active, and they also had considerable market shares in these areas. Sorry. So then let me talk briefly about the data. So we have some cool data sets that we managed to access, but then also to combine. And the combination we can do by using unique tax ID numbers that are both present in the credit registry, but also in the other data sources that we have. So from the CBRT, the central bank in Turkey, we get access to the Turkish credit registry, which is a great credit registry because it basically has no reporting threshold. So all loans are in there, even if they are relatively small, which is particularly important in the case of small and medium-sized enterprises. And very importantly, very basic, but very important, we know the gender of the borrower, okay? So many credit registries do not have that information. So you can do lots of interesting analysis, but you cannot compare male firms versus female firms. And so this is something we can do because this is actually registered in the credit registry, which is nice. And then, so a particular feature of the registry, which is interesting as well, is that it has information on bounced commercial checks for vis-a-vis suppliers. So this means that the registry not only takes stock of any non-repayment towards banks, but also when firms are not paying their suppliers, that is also red flagged in the credit registry. So that is useful information for us as well when we want to develop proxies for credit quality, for instance. Okay, and so that's what we do in part of the second part of the video.
More clarification that I was. Is it likely that the check bound cases are fewer in the actual lending cases, because banks may actually see this as a red flag, and maybe the expanded client list is more of those without bounces history?
So could you repeat that? Is the question whether banks actually take this into account, this information, or?
Yes. So is there prevalence of check bounces, in the actual borrower data set, because they may be screened out by the bank?
Okay. No, we do see, so that's a good point. No, we do see actually in the data that we look at, which indeed are all the firms that actually manage to get a loan, we see that there are bounced commercial checks in there. But one reason for that is, of course, you may check a client and the client may have a completely clean track record. But then after you give a loan, they may actually, start to non-repay their suppliers, and then they will basically develop a red flag after you've lent to them. So the dynamics may be the other way around. But yeah, we do observe this in the data. It's not that they all have a clean record. There are actually suppliers in there. There are actually firms in there that have not repaid their suppliers. So we're combining these data then with firm level VAT tax records from the Ministry of Treasury and Finance, so that has all information about buyer supplier links. So basically all firms selling and buying from each other in Turkey. So we have that information, and we can link that to the credit registry, which is great. So we can really focus on real effects. And then we have firm financials as well, again from the Ministry of Treasury and Finance, and it also includes gender. Now this is important because this also allows us to basically create a a group of female-owned firms that are not borrowing, and in certain exercises we can use that as a control group. Okay,
So
and
this
because
is
we have a
where
very
I was thinking maybe I've already done it. Like the fact that how much reliance they have on costly trade credit mapped
okay,
out and see how much substitution does occur.
yeah, that's a very good
Across.
point. Let me trade credit. So I have to check whether that's in the, but actual trade credit is in there. But we could be maybe in the firm. So I don't think it's in the credit registry, but in the firm financials, there may be information on delayed payments to suppliers, for instance, which is trade credit.
Because if you
So
reconcile the bank statement with the VAT data, you would know how delayed is actually the
yeah,
payment of
yeah,
receipts, right?
yeah. No, that's very nice. So we can do that. Thanks. That's a very good suggestion. Okay. So what we do in the paper in terms of identification is we use a difference and difference framework. We have 5 treated banks. So those are the banks that were selected by the EBRD and the European Commission, who were basically putting together this program. And then we have 19 control banks, which are very similar in along a number of dimensions, as I will show you in a second. Because of course, these 5 banks were not, picked randomly out of this set of 24 banks. So that is very important. So obviously we will take the whole idea of differences and pre-trends very, very seriously. Now, the other thing, and I will show you that visually in a second, is that the program rollout was staggered. So not all banks stepped into the program at the same point in time. And we're actually going to use that as part of the identification strategy. What we're also going to use are differences across banking markets, across districts, in terms of the pre-existing structure of these banking markets. And we're going to see whether the impact differs or whether the impact is heterogeneous, depending on the way the banking system looked in a particular district before this program was rolled out starting in 2015. So we first start with a bank level, a very straightforward bank level difference analysis, where we're going to compare basically the development over time of these 5 treated banks versus the 19 control banks. We're going to use synthetic difference and difference to basically reweigh and match pre-exposure trends to make sure by construction that the pre-exposure trends are parallel. And then second, we're going to use at the bank district level traditional two-way fixed effects methods, but also the stacking method developed in the QJE article by Cengiz et al., which basically makes sure that every time we have a event or a cohort, as they call it, we are comparing treated banks that start being treated at a certain point in time. We're going to compare those banks with never treated control banks, right? So we want to prevent that our estimates are going to be biased by the fact that some of the control banks actually become treated banks at some point in time. So that's what we're going to do as well. So at the bank district level, what I'm showing you here, we are basically running, straightforward regressions like this. So we have an outcome variable, let's say total lending to female entrepreneurs by bank B in district V in quarter T. We're going to saturate these regressions by bank time or bank quarter fixed effects and bank district fixed effects. Sorry, bank district fixed effects and district time fixed effects. We're controlling for time varying bank covariates. Then the coefficient of interest is beta 1, which basically tells us whether the lending behavior of a certain bank B in a certain district is different if it's a treated bank after it actually becomes treated. Okay, so this is a standard two-way fixed effects. And as I mentioned before, because that may be biased, because there is a staggered introduction of these banks, so they are not all 5 of them start at the same time, but they start at different times. We're going to introduce these cohorts and then also interact in baseline the fixed effects and the covariates with all of these cohort indicators. And so basically graphically, this already gives you an idea of what the data look like. Excuse me. So this is basically just raw data, but here you see the blue line, you see the control banks. The red lines is the average for the banks that were part of the program. And you see, so once the first bank and then the second bank start to enter the program, these banks actually gradually, we see an increase in the share of lending that goes to women, whereas not much or nothing at all is happening here in this period for the control banks. Now, we do see at the end of our observation period that there's some increase among the control banks as well. And so it's one of the things that we're currently looking at, what is going on there. But in principle, what we're going to compare is basically the situation here at the end with the situation here at the beginning, and the extent to which this gap here has actually closed at the end of this period.
Is there any implication of the 20% poaching that happens on the design of DID?
Yeah, that is so. Your earlier point about whether they are poaching from treated banks or not is in that sense less innocuous, because that could be a violation of the sub-fair condition, right? So we could see if there would be spillovers to controls that would violate that condition. So that is exactly for that reason we should look into this. I guess that's sort of the background of your question. Yeah, no, that's a very good point. So we should look at that. So yeah, for that reason I would hope that they're mainly poaching from control. Sorry, that they mainly would be poaching from other treated banks, but I don't know what the data say, so we'll have to look at it.
We have a question from the audience, which is related
Please.
to this point. Also, can it be observed if the poached customers were mostly from controlled banks?
Can it be observed whether absolutely, so that's the same point, I think, and that's a very good point. So yes, we can observe that, and we should look into that. Because we have the micro data, we can see exactly where new clients after the introduction of the program come from, and so that may either be one of the 4 other treated banks or one of the 19 controlled banks. So that's what we need to look at. Absolutely, no, that's a great point.
Yeah.
So this is at the bank level a comparison of the treated and control banks. So as you can see, they're actually quite similar, which is not too surprising, because we picked these control banks to actually be at least superficially similar to the treated banks. But what we do see is that these banks tend to be the treated banks tend to be larger. And you can also do this at the bank district level, which gives you more observations, of course. Okay, let me talk you through some of the results. So again, a map of Turkey. This is where the program actually, the borrowers under the program are actually located. So a bit similar to what I showed you earlier on, but an even more of a concentration in those areas where economic activity is high. So in the west of the country and in the south. This is, I think, a very neat, potentially, and I hope at least a very clear way of at the bank level showing the main result of the paper. So here the vertical line, you remember the 5 vertical lines I gave you earlier on, which were at absolute time. Here we have sort of collapsed that to 1 vertical line in relative time. So this is T is 0, the moment that the program starts. And then we take the average for the 5 banks. And so what you see is that not much is happening with the blue banks, which are the 19 control banks, in terms of the change in the share of lending to women over time. There's a slight uptrend over time, but you do see that as of period 0, the lending by the red banks, so those are the treated banks, actually goes up and actually stays significantly higher, substantially higher. Right, so I think this is a nice visualization of the fact that something happens once the program gets introduced, and it's also an effect that sort of increases and then sort of bottoms out at a higher level. Now we can look at that in regression format as well. So these are these bank level synthetic D&D coefficients, regressions. And so in the first column, don't worry, I'm not going to walk you through all of these columns, but the first column, we look at all types of borrowers. So you see that there's an increase in lending to female entrepreneurs, the number of female entrepreneurs, the share of female lending and total lending, and the share of female entrepreneurs and the total number of entrepreneurs that are being financed by the bank. And so we see that in particular, if we look at lending to female entrepreneurs, the number of female entrepreneurs, there is a significant increase. If you look at the share of female lending as well, so this would be a 2 percentage point increase in the share of the total bank portfolio that goes to women. Now, then the next columns are basically splitting this out into different types of borrowers. So you can have repeat borrowers or new borrowers. And then new borrowers, so those are the ones on column 3, can be split up in new to bank borrowers. So those are the poach borrowers or first-time borrowers. So that these are the people that are really being crowded in from scratch into the financial system. So those are people that have never borrowed before. And so I think what's interesting is that we find that actually a big chunk, and so as I mentioned at the beginning, about 40% of the program effect is actually due to these new borrowers, of which about half is actually due to these first-time borrowers. So it seems that a significant minority, or of the total effect is actually driven by these banks, drawing in new clients that have not been borrowing before, and I think that's interesting.
Some of the real effects that you would see, you might observe, I don't know, again, maybe something that I missed while reading the paper. There may be heterogeneity across these classes in terms of the real effects, right? If you are repeating.
Yes, yeah. So that absolutely, that's one of the things that we definitely want to look at. So I'm just going to see whether I can. There's a panel at the top of my screen, which is a bit annoying. Let's see whether I can move that. I can move it down a little bit. Perfect. So yeah, we haven't worked on that. So we're looking at we're in the middle of looking at heterogeneity in terms of the impacts on financial outcomes, but the real effects we haven't looked at yet. But that would definitely be interesting. Okay, so here we move to the bank cohort, the bank district level. So we're now going to basically try to explain lending by bank B in district D, depending on whether it's a treatment bank or not, or depending whether the bank in question had actually entered the program already or not yet. And so again, we find that both in terms of total amount in panel A or in terms of total number in panel B, there are large effects, and this is not only driven by, or not even mostly driven by lending to repeat borrowers, but to a large extent also because these banks are basically moving, allowing first-time borrowers to enter the market. Now you can do that in nice event study charts. So what this shows at the bank district level is that there doesn't seem to be, at least if we go back 1 year before the treatment starts, doesn't seem to be any pre-treatment trends or differential pre-treatment trends. Then once the program starts, we see over time that when you use traditional two-way fixed effects, or when you use the Senges et al. Stacked method, we do see that there are persistent increases in lending to female entrepreneurs. And so you can also look at the number of female entrepreneurs. This is total volume, this is number, and these results are I think quantitatively quite large, but they are also, as you can see, quite persistent. Now, another way of looking at that is looking at the share of female lending, right? So some of these, remember, part of the program was that these banks got access to additional funding, additional liquidity. So some of that may actually spill over to lending to men as well. Or it may even be the case that banks, they get these 300 million euros, and they may say, well, thanks a lot, we're going to spend half of it on lending to women and half of it on lending to men, or maybe even more on lending to men compared to lending to women. And so most of the liquidity may actually go to men. Now that's not what we find. So if we look at the share of female lending, or the share of female entrepreneurs in the portfolio of the banks, we do find actually very consistent results there. We do see that actually even relative to men, banks are increasing these numbers. Identification is not perfect here because we only have bank controls in here. We can go one step further. So again, we can show this here in the stacked events as well. So you see that in terms of shares, this seems to be the effects tend to remain quite consistent, but their precision actually starts to deteriorate 2 years out. Now, what we do here is basically try to get even tighter identification. So here we're going to basically create for each bank in each quarter and each district an observation that looks at total lending to women and total lending to men by that bank. And then we're going to create one big data set that allows us to include bank quarter fixed effects, but also bank district times gender fixed effects. And so what we see, if we look at that triple interaction term that we're now interested in, we actually see that after the introduction of the program, we see that treatment banks actually start to lend more, in particular to female entrepreneurs relative to male entrepreneurs. Okay, so this is basically a way to look at the test whether the impact on women versus men is actually statistically significant in that triple interaction sense. And we find that is the case, in particular, again, if we look at these first-time borrowers. And so to me, this is the more, in a way, this column 5 is the most interesting, but this is really about whether the program allows these banks to start lending to clients that are actually previously were excluded from the financial system. I'm going to skip this. This is about spatial heterogeneity in impacts, and so we basically what we show here is that most of the program has a bigger impact in areas where banks were doing less beforehand. But this is really a part of the paper that's still moving around quite a lot. So I don't think these are the most interesting results. One thing that I want to spend a minute on is basically to think about who are these first-time borrowers. So these guys in column 5 of the tables that I showed before, who are these people, and are they good clients, or are they maybe bad clients? So in one hand, you could say, okay, it's great that you teach these banks to lend to a new client group. They expand lending to women as a result, but maybe they are taking on much more risk, and that's not necessarily a good thing. And in fact, a couple of years ago, with several co-authors, I did a randomized experiment where we asked loan officers to actually take slightly more risk by identifying at the margin clients and randomly lending to half of these clients. And so we found actually that when you do that, when you push loan officers to do that, but you don't give them adequate training, they take more. They start to lend to borrowers that they are slightly less familiar with, but you see really a sharp drop in credit quality. And so this may have happened here as well. On the other hand, well, this program actually included a lot of training, so maybe the effects are more positive here. And so basically what we try to do here is to see whether these first-time borrowers under the program, under the WIP program, are actually different from first-time borrowers that enter the banking system at the same time, but they enter via a control bank, basically. Now, what we see is overall, I think, very good news. So there are a couple of variables that we can look at. And so what we find is let's look first at the coefficients that are statistically significant. So basically what we see is that over time, it's not that these first-time borrowers get a loan from this particular treated bank, but actually over time they also basically create new banking relationships and they get loans from other banks. So they're really anchored more deeply over time into the financial system. So it's not that they get just one loan from this bank and then they never borrow again. They actually become proper borrowers. And it seems like getting access to the financial system as part of this program was sort of the first step on the financial ladder. But we also see that they actually stick around with the banks, the treated banks that gave them that first loan. So there's no a higher likelihood of termination of the bank that they got the first loan from. And we also see in columns 5 and 6 that there's no higher or lower likelihood that these borrowers, these first-time borrowers, are actually more likely to default either on loans to the banks or on their obligations vis-a-vis suppliers. So that's a very roundabout way of saying that people that actually enter the program as a result, enter the financial system as a result of the program, tend to be relatively good borrowers over time, as evidenced by the fact that they are not more likely to default, and the fact that actually they become clients at other banks as well. And again, here the data from the credit registries, of course, are very useful to make that point.
We have a question from
Please go ahead.
Anshuman Pal. His query is, did the quantum of borrowing also increase once they receive the first loan, because they continue to be a good borrower over time, right? Yeah.
So whether at the firm level, so if that's the question, whether at the firm level these firms actually started to borrow more, then the answer is yes. So I think that's exactly the interpretation of well, okay, let me qualify that. So we do see in column 1 and 4 that the women that become first-time borrowers as a result of the program, over time, within the first 3 years, also develop relationships with other banks and get loans from these other banks. So that's great. What I'm not showing you here is whether the total amount of borrowing, and that's probably the question, whether the total amount of borrowing for these first-time borrowers is higher as well. And so that we can look at, but we haven't looked at that yet. But that's a very nice suggestion. Is that an answer to the question,
yes,
or is that?
Yes.
Yeah. Okay. I wasn't sure, but I think that's a very nice. That's a very nice point. We can look at that. That's yeah. Because I think the background to the question is there may of course be substitution between our bank and other banks. And even though we know that they are nominally still a client of the first bank, because we don't see anything happening in column 2, they may almost pay back everything to that first bank and then get a smaller loan elsewhere, in which case they will potentially be worse off. So it's something that we can look into. It's a very nice point. And then finally, we have some results on real outcomes. So to go back to the earlier comment, we're not looking at heterogeneity yet here across the country. But we do want to see whether, when we compare borrowers that are part of the program with borrowers that are not part of the program, whether there are differences, and we do find that is the case. So the outcomes that we look at here are the likelihood of survival or the likelihood of firm exit, total amount of sales, and the number of customers and suppliers that they have, and also the total purchases. And so then we can look at different horizons, so we can see whether these WIP borrowers, these programmatic borrowers, are different compared to non-WIP borrowers on a 1-year horizon, a 2-year horizon, a 3-year horizon. And again, so if you look vertically all the time, I think the results sort of consistently show excuse me, that if anything, these people, in line with what I showed you earlier on, are actually doing slightly better. They're less likely to default, and they grow faster in terms of total sales and total purchases.
These are matched firms, or?
Yeah. So exactly. So here so we look at firms that borrow under the program versus firms that do not borrow under the program. And then there's a combination of, there's basically matching on observables, either exact. So we compare these firms within the same provenance sector, and there's a propensity scoring matching as well, where we look at different firm characteristics and sort of match, compare nearest neighbors, basically.
Yeah, that looks interesting. Yeah.
So I would take this with a grain of salt, in the sense that we know that matching is is always an imperfect science, so to say. But if anything, what this shows is that these firms that are being drawn into the system through the WIP program are definitely not, developing worse as compared to regular borrowers. So I think that's a good outcome. Okay, and I can maybe talk about a little bit more about that in a minute. So to sum up, this is basically the same slide that I showed you earlier on, so I'm not going to talk about that. I hope the results have become clear by now. The other thing to point out is that I think that we're still doing a lot of work, and the way I see the paper at the moment is that this is in a way a very positive story about this directed lending. It really shows that if you teach banks to lend to a new underserved market and you give them training, you change their systems, you give them credit guarantees, and you give them the money to actually finance those loans, it seems to be possible to sort of steer them in the direction where you want to steer them. And of course, there are limits to what you can do. But in this case, in the case of female-owned enterprises in Turkey, it seems that this is a market where banks have been lending less than they may actually be wanting to lend to. And that's also evidenced by the fact that these if you look at the event study graphs, that these impacts tend to be quite persistent. Now, there are a couple of questions like, this is almost too good to be true, and I think it is. So I think that there are other things that are very important to check. So one thing that I think we should check, and we are working on, is to see whether, to what extent these learning banks to look at these markets actually works in the medium term, but actually fizzles out over time. So I think that is important. We really want to know whether these banks have changed materially or not. And then the other sort of suspicion that we have with these data is that banks, when you give them money and you tell them basically you can use this money, and maybe we give you this money at a slightly subsidized rate, but you have to on-lend to women, they may not necessarily lend to those female-owned enterprises that are most in need of credit. And so they go for the low-hanging fruit. And in one way they go for the low-hanging fruit is that we see that about 60% of the impact of the program is actually coming from more lending to already existing clients, right? So this is all intensive margin effects. But also at the extensive margin, so when banks lend more to first-time borrowers, I think a very important question is to what extent are these really the most credit-starved borrowers with very high implicit unleashed productivity growth. And so that is something that we're currently looking into by looking at marginal capital productivity of these MRPK of these borrowers. And so the results there seem to suggest, but this is still very much ongoing work, that it's actually the relatively unproductive enterprises that are being drawn into the system as a result of the program. And so this again goes back to this low-hanging fruit story. And this also means that, while at first sight these programs seem to work in the sense that you can direct banks to lend more to these clients that you're interested in, the selection may be in such a way that these bigger aggregate macro effects that you hope to achieve, in the sense that you really want to make sure that firms with great ideas that have very high marginal productivity, that those are the guys or the women that get access to credit, that may not be happening. So that is I think would be an important downside of these very undifferentiated programs. But this is something that we're still working on. So I would like to thank you for your attention. And so the latest version of the paper, or a version of the paper, will be soon available. So if you have the slides, you can always go back there and find the paper, or you can email me and I'm happy to share it with you once it becomes available. And I'm happy to take any remaining questions that there may be, of course.
Joshi, you're on mute, I think.
Sorry. In the meanwhile, if I had just one more, this again more clarification. Is there any variation in that training that is imparted?
Yes. So excellent question. So this is something we're looking into. So we know when the trainings took place, and we know which banks were trained when. And so we would love to explore and potentially exploit that variation, because again, one of the questions you may have is basically which of the elements of the program are most important. Is it about providing liquidity to banks? Is it about training them, or is it providing them with a credit guarantee? And so disentangling these things is not entirely straightforward. But since we have variation in training, this is one of the things that we're trying to do. So that's an excellent point.
Thank you.
We'll just put up as an additional reminder.
So I don't think there are any additional questions. Thank you to Dr. Ralph D. Haas. Very interesting presentation and very, very constructive questions from Joshi as well. So I think we can end the webinar now. So thank you. Thanks again for.
Yes, sir. Yes.
Thanks
Thank
again.
you, thank you all the participants for raising some intelligent questions, which are helpful for us. But thank you.
Absolutely. Thank you very much for that. I mean, I made notes, so I hope that in the next version that will be up, a lot of your suggestions and comments will be reflected. That was super helpful. Thanks very much.
Thank you.
Thank you.
Thank you.
Good night.
Bye, everybody.
Yeah, thank you.